If you are getting into options trading, everything revolves around one single number: the strike price. Think of the strike price as the line in the sand. It is the exact predetermined price at which an options contract allows you to buy or sell a stock. It doesn't matter where the stock price goes tomorrow, next week, or next month. The strike price is locked in stone the moment you trade the contract. If you buy a call option, the strike price is the price you have the right to buy the stock for. If you buy a put option, it's the price you have the right to sell it for. Let's look at how it actually plays out in the market. Let's use a concrete example. Say Apple is trading at $290 right now. As a trader, you can choose any strike price you want on the options chain, either below the current price or above it. Let's say you choose a target above the market and buy a $300 call option expiring in 1 month. To lock in this right, you pay a price, called a premium, let's say $5 per share. 2 weeks later, Apple drops a massive earnings report and the stock rockets up to $320. Now, a beginner would say, "Awesome! I have the right to buy at $300 and the stock is at $320, so I just made a clean $20 profit." But a top trader will correct you instantly on 2 things. First, you don't actually exercise the option to buy those physical shares just to flip them. That wastes time, capital, and racking up heavy transaction fees. Instead, you simply sell the options contract back into the market to collect the massive surge in premium. Second, your net profit isn't $20. You have to subtract the $5 premium you paid up front. Your actual net profit is $15. This means your real break-even point was actually $305, $300 strike plus $5 premium. Anything above $305 is pure gravy. On the flip side, if Apple only moves up to $295, your option expires worthless and you lose that $5 premium entirely. Why use a contract to buy at $300 when you can get it cheaper in the open market for $295? When you open up your trading platform, you're going to see dozens of different strike prices. They all fall into 3 specific buckets relative to the current stock price: in the money, at the money, and out of the money. For call options, if the stock price is already higher than your strike price, you are in the money. Your contract has built-in intrinsic value. If the stock is below your strike, you are out of the money. Now, for put options, it's the exact opposite, because you are buying the right to sell. For puts, you are in the money if the stock drops below your strike price, and out of the money if the stock stays above it. You are winning when the market is falling. Choosing your strike price is a mathematical balancing act between probability and cost. Buying a strike close to the current price, at the money or in the money, costs more upfront, but it gives you a much higher probability of winning and far better risk management. The bottom line is this: an options chain isn't a guessing game. It's a menu of risk and probability. Every single strike price you select is a direct, calculated trade-off between the upfront premium you pay and your mathematical chance of winning. Stop chasing cheap, low-probability lottery tickets. Master the strike price, respect the time decay, and start trading like a business.